Well, it's that time again. Time for another monthly edition of your Rogers Capital Monthly Market Commentary, where we attempt to be the antidote to water cooler wisdom. On January 19th, this past month, the S&P 500, the market closed at a record high of 4,839. Ending a 745-day consecutive days below the previous high. Developments in artificial intelligence, I think hopes to data suggesting the Fed may begin to cut rates earlier, maybe even in March, led to record highs. Investor sentiment climbed. In fact, the American Association of Individual Investors surveyed and reported that 19%, just 19% of Americans were bearish, pessimistic for the coming year. And this was done in December. That's nearly a 6-year low for that metric. Investors may, though, have overestimated the rate cut possibilities, especially in March. In fact, Fed coming out just a few days ago and suggesting that it's unlikely. The economy remains so robust. Inflation, as measured by CPI, accelerated from November to December. Fed rate left rates unchanged, but indicated that rate cuts are unlikely to happen without further evidence of a continued slowdown in the pace of inflation. The month of January, S&P saw a 1.68% rise. 5 of the 7 sectors of the index were positive. The top performer was communication services, the big tech names. I think a lot of us would recognize the Facebooks, the Googles, up over 5% actually in a month. And the worst performer was real estate due to rates, continuing to be high, softening economy, actually down almost 5%. In the wrong direction. Q4 earnings season began mid-January with 35% of the S&P 500 companies having reported by the end of the month. The blended earnings growth rate stood at a negative 1% for month end, which is tough when the consensus estimated growth rate should have been, or was positive, 1.6. So you've got a 2.6% swing in what we were hoping for and estimating, and then what came through. But driven by, again, the continued advances in AI, IT and communication stocks up big. And this AI topic, forecasts regarding the potential impact of AI on worldwide GDP growth, worldwide production, are just stunning. This last month, PricewaterhouseCoopers estimated AI integration will increase global GDP by 14% between now and 2030, so just 6 years. The staggering part is that's $15.7 trillion of global GDP growth. Bonds have kind of been interesting to watch as well. Bond indices year over year up almost 8%, driven by several things, I think. One is an expectation that rates will begin to come down. Probably, 2 being the fact that they got hammered in the last year and a half, and so we're seeing some rebound in those prices. Here in the U.S., continued economic growth and the trajectory of inflation, which we have been watching and discussing for a year and a half, 2 years now, create a pretty serious challenge for the Fed. On one hand, GDP growth stood at 3.3% in Q4. And inflation is down huge from the 9.1 we topped out at. And it feels like the Fed has navigated this well, could orchestrate the soft landing we've been talking about. Now, on the other hand, CPI inflation remains above target. The target's 2, and we're a ways from 2. And, as you heard me mention earlier, we went the wrong way. From November to December, we went from 3.1 to 3.4. As many investors, as you are all likely aware, an ill-timed cutting of rates when we're not quite through with the inflation could set off a fresh surge in prices, inflation, an outcome the Fed is obviously hoping to avoid. So it'll be interesting to see. Well, that's it for this time. We're going to do a little something different, I think, next month. Explore a topic you may be hearing a little bit about, Roth conversions. What's that about? Who should be doing that? Who shouldn't? So provided nothing crazy happens in February, knock on wood, we'll cover that next month. We'll talk to you then.